All right, good morning. Welcome back here to TMAcademy. Great to have you. We'll get started here just a few minutes early, testing out the sound and making sure everything is going smoothly from a technical standpoint. But we'll get started here in about 60 seconds. All right, good morning. Welcome back here to Trader Minute Academy. Great to have you aboard. My name is Jeff Yady. I am the founder of Trader Minute and one of the traders and trainers that you hear from in the TM Academy. And today, going to go out and build a little bit on what we talked about last week. And last week, we took a little bit of a look inside the Academy and some of the things that were going on with the MarketVibe and some of the trainings. But today, I want to go out and take some of that training, take the MarketVibe, and actually go talk about some real-time trades that are setting up out there right now based on earnings season and some of the analysis we can do on earnings season. Now, if we go in and just kind of log into the academy here and come into the trainings, there is a section here on fundamental analysis. And in this section, it goes through and kind of breaks some things down, talks about some of the earnings elements that we're going to use here today. And so today, I really just want to take and go and apply those things and really kind of look at some of the emerging opportunities that are setting up in this market right now. And let's face it, in the market right now, there's a lot of questions, right? You see analysts calling for big melt up type action in the market. You have analysts calling for big breakdown action. But the reality right now, the market's not moving. Right? The market is not in any sort of movement phase. And, that just brings on more questions, and we're starting to get some answers when it comes to earnings season. Not a whole lot in terms of the market, but in terms of specific sectors and specific stocks, we're getting some answers. And so let's go take a look at a couple things that are bullish, a little bit more or a couple things that are bearish, and a neutral trade here that is set up in a just a fantastic way right now. Let's talk. Let's start with the bullish. And I'm going to come in and take a look at a stock, and this is Visa. Now, Visa reported earnings on Wednesday after the bell. Stock went down yesterday, and when I got onto Trader Minute to talk about it in real time, I made the comment that this is a really good earnings report, has very few reasons to be sold, and actually should be bought, not sold when it comes to Visa. One of the reasons I said that is because when we look at this earnings season and we look at the aggregate of revenue growth for the entire S&P 500, it's about 5%. Right? That's about what the earnings or the revenue growth is right now. And let's face it, revenues matter. Right? Revenues matter more than earnings in many, many cases. 5% average. What Visa come in at? 8%. 8% revenue growth. Fantastic number, right? Fantastic number. But more importantly, right? More importantly than that is they are in this phase or in this story right now of runaway revenue growth over time. And what do I mean? Well, let's come in and chart some of their revenue growth here. And here you can see the earnings. And this is quarter after quarter after quarter, right? And you can see that overall, whether you look at Wall Street estimates, the actual number, revenue quarter over quarter over quarter just continues to grow and grow and grow, and is expected to continue to grow and grow as it goes forward. Now, it's not just doing that on an earnings side, it's doing it on a revenue side. And the revenues just continue to skyrocket here for Visa. Since Visa IPO'd, right? And let me come in, I'll show you the chart here. But we'll just get rid of all our indicators. But since they issued stock here on Visa, and let's just make sure we come into a lifetime. Let's go 10 years. That'll definitely get it. All right. So 2009 went IPO, right? And they have continued to rise, continue to increase here. Let's go back 12. Okay, here we are, 2008. But one of the things that has happened here with Visa is, yes, it is surged. It's just been straight up over the years. But every single quarter since the company IPO'd, except for 3 quarters, there have only been 3 quarters where this hasn't happened, the stock has hit a new high. It's been an amazing run. An amazing move here for Visa. And what's more interesting about that is that the numbers continue to improve at almost a better rate than what they were back here. Now, oftentimes Visa's looked at as a financial company, but let's get to what it really is. It's a tech company. This is a financial tech company. They're not holding big amounts of debt. When customers swipe their Visa card, Visa's not on the hook, right? Visa's just making the transaction charge. So every time somebody swipes a card, boom, Visa gets paid. And we continue to see globally the number of transactions continue to rise, in terms of how many cards are swiped, and that continues to benefit Visa. Now, Visa's a cash printing machine because of that, right? They're not holding the debt, so they don't have to, kind of deal with all of that, all of those elements. And they continue to just have gobs of cash coming in quarter after quarter, year after year. And what do they do with it? Well, right now, they have an $8.5 billion buyback. Now, oftentimes you hear people talk and they'll say, hey, you know what, buybacks, those aren't good. Those are a sign that the stock's at the top or something like that. But that hasn't been the case with Visa. Visa's been buying back shares with their cash year over year over year, and they are investing in themselves, and they continue to turn it into more cash going forward. But perhaps one of the best things when it comes to Visa is the fact that they are making more money per dollar that they bring in. So if we come in here, and I'm going to come into a site called Y Charts where we can chart some fundamental data to look at margins. Is one of my favorite places to come. But if we just come in and take a look at margin, and let's just come to operating margin. Okay, and what is operating margin? This is how much money the company makes per dollar spent, right? 62%. That's a huge number. Now, that hasn't changed all that much over time, right? It's always had a really nice operating margin, right? But what about profit margin? Right? When you kind of sort everything out and, you kind of say, hey, you know what, let's kind of take the expenses and everything else. Profit margins are almost 50%. And they're at an all-time high, and they've continued to improve margins year over year and continue to not only grow the revenue or the dollars coming in, but how many of those dollars actually convert to profit. In their earnings report, there's no sign of that changing. There's no sign of that slowing up. Yes, will Visa sell off if there are economic concerns and the market pulls back? You betcha it will. If the market pulls back and pulls back aggressively, right, Visa will sell off. It's not immune to that. When we have seen sell-offs in Visa back here in 2010, this is the flash crash. Visa sold off, right? Here's the Lehman Brothers crash. Visa sold off, right? In 2012, we had the Euro crisis, right? Visa sold off a little bit. Here in 2018, we had a pullback in the market. Visa sold off. So it's not immune to pullbacks. It's not immune to, these sell-offs, but it really is. It is one of those that, yes, it may get sold, but it will get bought back up and pushed into new highs until we see something that absolutely thwarts their business model. And so far, nothing like that on the horizon. So one of the best stocks to be a buyer of out there right now, and to hold for the long term. I'm not in Visa presently. I would like to see a little bit of pullback. I don't think I'm going to get it. I think it may not come, but from a stock standpoint, it's one of those where you kind of, the story is good enough to buy anywhere. From an option standpoint, you wait for a little pullback and you use that as an entry point. But one of the best stocks out there emerging from this earnings period, and what's really nice is it's not a new story. It's a very old story that continues to get better. This morning, Amazon, or yesterday after the bell, Amazon reported earnings. And I you know what, we could talk about Amazon all we want, and Amazon's been a great story, and they do different things, and they have Amazon Web Services and shopping, and they're going to do one-day delivery, which we'll talk about again. But they also said something in their call that was very interesting. And it's something that probably isn't, going to be, reverberating through the markets. But they made this comment about streaming music and about investing more and growing more of the streaming music. So what's the big deal? Over the years, when Amazon decides that it's going to enter an industry, normally the stock gets sold. They're going to go and they're going to come back here in 2014. They're going to get involved in the cloud. They're going to put Amazon Web Services together. They're going to go compete in this marketplace that's crowded, right? Adobe, Microsoft, Salesforce. There's a ton of cloud stocks. Oracle. They're not going to be able to compete, right? No. What they step into industries that are growing to where they don't have to carve out and steal market share from other people or other competitors. There's enough growth in the industry that they can step in, grow big, and not have to worry about the competitive aspects to the same degree because the industry itself is surging. And that continues to pay off for Amazon. And they make these decisions over and over the course of the last 20 years, and they continue to pay them off and pay them off in a big way. So what did they come and announce here today? Well, they announced that the headlines are full of this one-day shipping for Amazon Prime. Okay, great. Fantastic. That's going to hurt FedEx, right? And we're going to talk about FedEx here in a moment. But that's going to hurt FedEx. That's going to hurt UPS. But this streaming music element, the first thought is, you know what? Spotify, right? They IPO'd about a year ago. This company's going to get hurt because, you know what? Amazon's going to come in. They're going to crowd the market. They're going to take the market away from Spotify. And Spotify's just going to kind of go the way of the dodo, right? Wrong. That didn't happen in cloud. That didn't happen with Amazon Web Services. Amazon Web Services coming in, we actually saw the whole industry grow and grow faster than what Amazon Web Services could grow. Take a look at this. Global annual paid streaming music value projected in billions of dollars over the coming years. Take a look at the growth in streaming music and the projected growth. It's massive. From 2018 to 2020, this is an industry that has been growing, but whose growth is accelerating. Amazon announced yesterday that it was, they're already in the industry. They already have Amazon Music, but they announced that they're going to be stepping it up, that they're going to be getting a lot more involved, that they're going to be, really kind of fine-tuning it. Why? Because it's a massive growth industry. And what did they just do? They allayed a lot of the fears that investors in Spotify have had of, can the growth in the industry continue? If Amazon's stepping in, if Amazon's kind of saying, hey, you know what, we're ready to make this a go, they're getting in not to compete. Obviously they'll be competitors, but they believe that there's room for both. And when you look at how the growth is in emerging markets when it comes to streaming music, yeah, the U.S., some of the more mature markets in the world, maybe topping on out, but those emerging markets are just getting started, and that's where the penetration is just starting for them. Can you buy Spotify today? Absolutely. Absolutely. Has a couple elements here to it. One of them, slow stochastics coming off of the 20, right? You don't see the slow stochastics come off the 20 very often, but when it does, the stock almost always goes up. When it just comes right off the exact level of 20. Don't ask me why. I call it voodoo technicals, when it comes to the stochastics and the 20. You go look at chart after chart after chart, you'll see it happen over and over and over. It has that element here today, but that's not why I want to be a buyer. I want to be a buyer because of what Amazon said and what fundamentally is driving this industry and the growth prospects for the industry going forward. Right now, we're in a marketplace where investors are questioning, okay, what's going to be the growth going forward? Is Honeywell going to be able to grow? Is Caterpillar going to be able to grow? Is Ford going to be able to grow? All these companies, are they going to be able to grow? Is the economy going to grow? A lot of just questions. Well, this is an industry that's having some of their questions answered about future growth. And if some of the estimates are even close, we're talking about a company that could be trading up into the $300, $400, $500 range over the course of the next year to year and a half when it comes to Spotify. So Visa, Spotify, two of my favorite setups out there when it comes to what the earnings season has said so far and what the earnings season has delivered so far. You'll notice Spotify hasn't released earnings yet. Right, they haven't come out with their earnings report. Visa did, but we got a lot of information about Spotify here today. So that's on the bullish side. On the bearish side, right? On the bear side, there's one stock that just absolutely stands out, and that is Fedex. Now, Fedex didn't release earnings here today or yesterday. Fedex released earnings right back here in March, and the earnings were terrible. The earnings were terrible, and they were similar to what they had reported in December. When they reported in December, FedEx investors had to start looking at FedEx differently because FedEx had been one of the darlings, right? One of the darlings of the market, every investor in because it's just such a great company. It continues to go up. Amazon business continues to grow. Shipping, e-commerce, that's for FedEx, and FedEx is going to continue to rise in a big way. But some of that started to change. And when we go and we look at FedEx's numbers and what they did relative to expectations, right? Here's the earnings, right? Now, when we look at this plot, okay, this is for fourth quarter of 2018. This is for fourth quarter of 2019. What's different about this and Visa? Well, Visa has this chart where earnings quarter over quarter, year over year, going on higher, moving on up. What about FedEx? They have the opposite. They have the opposite coming in. The next quarter, down. The next quarter, down. The next quarter, projected up. But what do we know? Revenue projections or earnings projections always get revised down, or that's kind of the norm. So it'll probably be revised down just a little bit. But that's on earnings. Okay, fine. Big deal. But take a look at the revenue, right? Look at the revenue miss. Massive, massive revenue miss. What's going on? What's happening? Well, they're dealing with a change in Amazon. They're dealing with a change in global shipping. There's more competition coming in. There are more demands coming in. And when you look at global shipping volumes, they're starting to slow. If you have a bearish thesis on the global economy, there may be no better stock to trade lower to short than FedEx. Because they're starting to see holes in their earnings and in their revenue they're missing expectations. They're seeing declines. And you know what? There's still not a consensus out there in the market that there's global slowdown happening. If global slowdown now gets added to the equation, FedEx is in trouble. UPS reported earnings yesterday. And FedEx, after this earnings report, right, we knew all of this back here in March. But the market itself just kept going higher. And you know what? Investors took FedEx and took it to 200. Just not a lot of volume, not a lot of conviction in it, but continued to drive it higher with the market. And then there was a little bit of a dose of reality. You know what? Some of the negatives that FedEx are dealing with, that's not just a FedEx issue. That's also a UPS issue. It's an industry issue, not a specific one stock, issue, an entire industry issue. And UPS confirmed what we had seen in FedEx on their earnings prior. And FedEx, investors got hit. Take a look at UPS. Earnings missed, right? Not only that, but earnings year over year decline. Decline year over year. That's very different than other stocks, and on a big revenue miss. When you look at revenue growth in the market right now being on average 5%, and you look at what UPS and FedEx revenue growths are, they're not even keeping up with market average. Both of these stocks, very similar plays. Now you throw into Amazon last night coming out and saying, hey, we're going to do one-day shipping. What does that mean? Is FedEx set up to be able to take a bulk of that? No. Are they going to have to make further investments or spend further dollars to be able to help with that? Yes, they will. Are those dollars going to ultimately pay off as Amazon's also looking for alternate shipping methods? They may not. So FedEx is in a very tight, very sticky spot right now, and to me, one of the best bearish stories out there in the market right now, and something where if we get a market rollover, most things are going to go down. FedEx to trade below 100 on a big downturn in the market is probably what we see. On a small pullback in the market, at least a revisit to the lows from December. Okay, so that's my favorite bearish story. Bullish stories: Visa, Spotify, bearish. They're FedEx. Now, I mentioned there was a neutral trade out there, and it's a very interesting one. Honeywell, we talked about last week, and we talked about what the CEO of Honeywell said. He said it's very difficult to gauge valuations of companies out there in the market right now. Very interesting comment. Well, Honeywell has a competitor or, a company who does similar things. Yeah, a few things different, right? But they're both big multinational industrial conglomerates. I don't think Honeywell makes Post-it notes. But Triple M reported earnings this week. You can see by the stock reaction, it was pretty negative. And you go through the report, and you almost wonder maybe the stock reaction wasn't negative enough. Honeywell, very nice report. Triple M, a disaster. And if you go through the call, it's really funny. They talk about missing because of economic conditions and then talking about how strong economic conditions are. It's very amusing. But what's the trade here? Well, a Triple M can bounce from here. Triple M can fall from here. The market can go up big from here. The market can go down big from here. But yesterday we started to see what the trade was, and we started to see it emerge. And here I'm just going to come into a 1-minute chart of Honeywell yesterday. And Honeywell gapped down and sold off, right? Gapped down and sold off, and then rose as investors started to buy it. What did Triple M do? Well, wasn't investors doing the same with Triple M? Investors, yes, Triple M gapped down, and they continued to sell Triple M for the rest of the day. If you're an investor and you need that big multinational conglomerate space, who do you want to buy? UTX, Honeywell, Triple M? Yeah, you don't want to touch Triple M. Triple M has become toxic with this earnings report. It's going to take a long time for them to recover. They have lost investor confidence. So what's the trade? Well, the trade is long Honeywell, meaning buy Honeywell stock, and short Triple M. Sell Triple M stock. And you sell the same dollar amount, right? Not the same number of shares, but the same dollar amount. So if you're going to do, 20,000 in Honeywell, do 20,000 in Triple M. Honeywell long, Triple M short. What happens? Well, this is a combo trade. This is something we used back in my fund managing days quite often. We say, market has a lot of uncertainty in it. And you know what? I don't want this trade to be dictated by what the market does. Because let's face it, if I go out and I buy Visa right now, and the market goes down 20% in the next 3 months, Visa's not going to hold up. No matter how nice the stock is, no matter how great the chart is, no matter how bullish the story is, Visa won't hold up. But here, I don't have to deal with the market. Because what I'm looking for is for Honeywell to outperform Triple M. That's all I need. If the market goes down 20%, fine. If it goes up 30%, fine. Because if the market goes up, both Honeywell and Triple M will go up. But Honeywell's going to go up at a much greater degree. From a percentage standpoint, it's going to go up more. So Honeywell may be up 20%. Triple M probably be up 10%. What happens? I'm going to lose 10% on Triple M, but gain 20% on Honeywell. I'm making 10% differential there. Not a bad return for a stock trade. If the market goes down big, Honeywell may fall 20%. But if that's the case, Triple M's down 30%. I'm still making that 10% differential. Only Triple M's my profit, Honeywell's my loss, but my profit will be more than my loss. From time to time, the market sets these up, where you can take a look at two stocks in a very similar industry and go, okay, based on their earnings going forward, the performances of these stocks are going to be very different. Yeah, the market's obviously going to have its say in it. Big market up, big market down will obviously affect it. But that differential, we're going to see Honeywell most likely outperform Triple M. That's where I can go in and take advantage of. And so from a neutral standpoint, you don't have to be worried about the market. You don't have to be concerned about market direction. You can step in. You can look to play that differential in the stocks. Last but not least, the market itself. Right, we've looked at a bullish play, two bullish plays, a bearish play, a neutral play. But the market itself. What's the market been doing? It's been just grinding higher. Slow, steady grind. Most days the market's just not going anywhere, just not doing anything. You know what? It gaps up a little bit, then sells off and rallies back into the close. It's not a condition for speculative option trades. And it's one of the times right now where you go and look at the headlines, you go hear these big analysts making these calls for a big drop or big pop, and there's this temptation to say, hey, I want to go get into a directional play and take advantage of the next big pop or the next big drop when it comes down to it. But with that, take a look at the market vibe, right? Take a look at the market vibe. Right now, the market vibe, it continues to be neutral. Right? What does that say? It says the market's not going to have a huge move. Yeah, it'll drift up, it'll drift down, but the movements are going to be very small. In fact, over the lifetime, the average daily gain, there have been 329 days of neutral with total gains of 2.6%. There's just not a lot of move on neutral. Where do the big moves come? When bearish and bullish are triggered. So great. Want to play option for the next big move up or the next big move down? Feel like you're sitting there going, man, I don't know when to call it. I don't know when to get in. Well, put the odds in your favor. Wait. Right? I mean, options have time decay, so why bother with that? Why go out and buy a September option today that's just going to decay a little bit each and every day while the market remains in neutral? Wait for it to trigger. Triggers bullish, triggers bearish. Now the odds are in your favor. Triggers bearish, market puts, go. Your average daily gain is going to be significantly greater. Your chance of catching that lightning in a bottle on a big down drop increase tremendously. Are you going to hit the absolute top or bottom? No, you're not. But are you going to have the odds in your favor in a big, big way? Absolutely, right? And right now, the market's been neutral for quite a while. I mean, this is the longest neutral period for the market in well over a year. What do we know? Well, the longer the market remains neutral, the bigger the next move tends to be. And so ultimately, there will be a move. But wait for the internals to move. Wait for the market metrics to move. The best way to see it, via the MarketVibe. You can come in, check out the performances in here. They're fantastic. And it's updated each day of what that signal is. Wait for puts till the market gets bearish. Wait for calls for the market to get bullish. I only say that for marketplace, right? This isn't something, just because the market's neutral doesn't mean Apple's going to go flat. Doesn't mean Amazon has to be flat. Doesn't mean Micron can't go down, right? Neutral is for the market index in and of itself here. And if you're looking to play the market, keep a close eye here on the MarketVibe. All right, so those are some of the best trades, some of the trades that I like out there right now. Now, in the coming weeks, I will be starting a new 100K challenge, live trading challenge over at Trader Minute. And we'll be kicking that off. I will be trading some of these stocks: Visa, Fedex, the SPY, Honeywell. We'll be looking to make trades on those and timing up option trades on those. And one of the things that you'll get here, I believe this evening, if I'm not mistaken, you'll be getting an offer to sign up for the Academy. It's a one-time sign up. You get all the training, all the education. You get the MarketVibe complete, updated every day, and then you get the next 100K challenge that we'll be kicking off. You get access to that for free. You'll be able to see the trades live as they're made, get trade alerts for those on the entries, on the exit, to kind of learn how to kind of set up and say, hey, okay, how can we get involved in the market with a little bit of money, be able to trade in this high-risk options arena, but yet not take a huge amount of risk. It's a one-time, lifetime access here to the Academy. You sign up, 3 days, no questions asked, money-back guarantee if you're not happy for any reason, no risk, but great education, great opportunity to get in and learn how you can get involved in the market, be able to find some of these plays on your own, and be able to profit and take advantage of them in the months and years to come. Thanks for joining us today. I wish you great success in trading, and we'll talk to you later. Take care.